Good morning and welcome this morning to Trading Futures, another great webcast from Schwab Coaching. My name is Ben Watson and I'm an education coach and senior manager here at Charles Schwab. I'm joined out there in the chat by my good friend, Michael Fairborn, another phenomenal educator, 20 plus year veteran of the financial markets and a good friend of mine. And Michael's there to help facilitate the chat, answer your questions along the way. So be a part of the conversation, whether you're here in the live version or the recorded version. If you're here live, chat in your questions. If you're here in the recorded version, do us a favor and leave us a comment in the comment section. We'd love to respond to that as well. A couple of things, though. We've got, a fair amount of news going on. Number one, in the technology space. Number two, we've got a little bit of a drought of economic indicators coming up in the next little while. We're following now this week the Federal Reserve cutting interest rates by a quarter point. So that's going to factor into kind of the discussion. And we've got Chairman Jay Powell talking today, perhaps adding some clarity to the intent of future potential cuts. So all that's going to kind of factor into the discussion, but we're going to jump into what's moving and what is maybe not here this morning as we jump into futures and getting into this discussion. So a couple of quick reminders. Everything we talk about is simply for illustrative and educational purposes only. It is not a recommendation. It is not any kind of advice. Remember that futures and futures options trading requires separate trading authorization. It has substantial risk. It is not suitable for all investors. Make sure that you're aware and have read the risk disclosure statement for futures and options before considering any futures transaction. Also, make sure that you have a good understanding of futures margin. We'll talk a little bit about that as we get into the discussion, as well as point you in the direction of some additional resources. Also, remember that as we talk about things like virtual currency derivatives, those have unique and significant risks. They are digital representations of value that function as a medium of exchange, but do not have legal tender status. So there are a couple of things that we want you to pay attention to when we look at virtual currency derivatives. So make sure that you have read the NFA Investor Advisory Futures on Virtual Currencies, including Bitcoin, and the CFTC Customer Advisory, Understanding the Risk of Virtual Currency Trading. We may talk about those today in this discussion. Now, we're going to be using the Thinkorswim desktop software platform, specifically the paper money version. It is not a guarantee of future success out there in the real world. It is, however, a great sandbox in which you can practice and learn. Remember that the paper money version doesn't do certain things that the live money version does. Now, we're going to use technical analysis as a large part of this discussion. But remember, the technical analysis is only one way to look at the market. Schwab doesn't recommend the use of technical analysis as a sole means of investment research. Remember that investing involves risk, including for some products more than your initial investment. Now, that holds true certainly for futures contracts. Now, remember that in the futures world, stop order is not guaranteed at execution, and stop orders that generate a market order, so stop market orders, may be substituted or may be rejected by the exchange, but may be substituted by an exchange designated limit order for that originally triggered market order. That's based on the exchange designated protection range or protection points. And that's because futures markets can and do move very quickly. And you can see a circumstance where an order may not get filled because it's moved outside of that protection point range. So we'll talk about that as we get into the discussion, but just a quick reminder about that so that you have that in your mindset. Let's pop over here to the Thinkorswim desktop software platform, see what's going on at the moment. And I've got a couple of trades. I had a couple of trades on already this morning just because the market was up and moving pretty quickly. And it looks like one of those went to our target. One of those is still working. So let's take this one that is closed first of all. That is the /M2K trade, the mini Russell 2000. And so we're going to pop over here to the charts, to our futures grid. /M2K is the symbol And I'll show you the trade that I put on here. But again, for those of you who are brand new to this webcast, and by the way, we just got done with a market drive event in Dallas, Texas on Saturday. Met some of you there in person, re-met some of you in person who were there. And thanks for being there. Thanks for joining us and coming back to this Futures webcast this morning. It's good to have you. So this particular futures trading grid is very simple. It's simply on the left-hand side, a one-year daily chart, on the right-hand side of today's trading 5-minute chart. So that means the candles or bars on each one of these has a different time frame, a different period. These are daily bars over here on the left. These are daily or 5-minute candles over here on the right. And I've got a label on here. By the way, all of these grids and all these labels are linked in the description for this particular webcast. So you can find those there. You can download them and put them in there for yourself. All right. So I want to show you the trade really quick, and then we'll come back and look at the circumstances of this particular futures contract, and then we'll take a look at the other trade that's going on. So here's what I was watching this morning. This is the Micro E-mini Russell 2000 futures. And we've talked about this before. The tendency for the small caps, which is represented primarily here in the Russell 2000 futures market, the tendency for small caps to move in response to interest rate cuts, because those small caps tend to be oftentimes startup phases or mid growth phases. They tend to rely more heavily on debt. They tend to be more concerned about debt service. And the thing that controls debt service is interest rate significance, right? So if you have a significantly higher interest rate, the debt service load on small caps is going to be higher. You cut that rate, that debt service load is going to be lower, and that's going to free up capital for them to grow, frankly. So oftentimes that's what the relationship, right? So small caps tend to be interest rate sensitive. Kind of starting to see that today in terms of the playing out of this move. So started to see this morning as I was beginning to watch this, right off of this maybe a little bit of a double bottom here, if you will. Right around the 4 o'clock time frame, started to see that double bottom. It broke out of the double bottom, and then it created, just going to zoom in over here, created this bull flag. So rally up, pull back. So I drew the bull flag move, and I really drew down to this kind of low area here. And then I took that level and I duplicated it up here to the upside. And I put it in an entry order. So it was a buy stop order in this case. So my entry in this particular case was at 2480. I think it was right at 2487. That was the buy stop entry. And the reason I did that as a buy stop entry, and again, remember, even a buy stop that generates a market order is going to be worked as an exchange designated limit order. So I could have done it as a buy stop limit. But the reason I didn't want to get in somewhere in this range right here between the bounce and that resistance is I wanted confirmation that price was in fact moving higher. So it really wasn't until I got this trade right here, above that entry price, above that buy stop price that was existent, that I got into the trade. And then it pulled back. Now I put a stop on here, and it was a fairly tight stop because if this started going the opposite direction, I wanted to get out of the trade pretty quickly. So the stop in this particular case to the downside was at 2485. So if price had blown down through that level after we entered the trade, because you can see this candle right here, that red candle with that long tail blew down through that level just slightly, but I wasn't in the trade yet because I didn't put the order on until right about here, and it didn't fill until right here. So it had already gone down through there. But it started to worry me a little bit because it was starting to pull back towards that level of support. Now it started to take off, and my target was simply a duplication of that bull flag flagpole up to the 24. I think I went 2492 even, or maybe 2493, probably 2492 even on that point as my exit. And it did that in the space of one or two candles. Now, here's the thing. And as we talk about this and we see what's going on, had I just simply left it without a target, is there the possibility that I could have taken a couple more points of gain potentially in the trade? And the answer is yes. The problem is, especially with these fast moving futures, especially early in the morning before the cash market opens, is that you can get quick reversals. So leaving that trade on there, and you can start to see that happening here. Again, that little bit of a pullback. So we're going to watch this. We may get this little bit of a quick reversal. We're going to watch this for this to create a bit of a bull flag, another bull flag type pullback. But you notice what's going on with MACD. MACD is moving up towards that upper range of where it has been. I mean, we've got some pretty good momentum going on here. So we could argue that, hey, we've missed part of the move. Yes, we have. We could also argue that we caught, perhaps a pretty good portion of that move. And now we're positioned to take another opportunity to jump in here. So the other thing to think about is, depending on the size of a portfolio, depending on the capabilities of that portfolio to sustain the margin requirements of a trade, one way to accomplish this might very well be trade a couple of contracts and take one contract off and let one contract continue to run. That's a possibility as well. We did not do that here, but again, that's going to be dependent upon risk tolerance and risk and margin capabilities, right? So starting to see that longer upper shadow, and this candle is kind of turning red, green. It's doing the stoplight thing here. And that's a little bit of a shooting star type of candle. That shooting star type of candle may give us an opportunity to see this pull back and create another bull flag. That's how typically trends move. But in a larger sense, I want you to kind of keep in mind what's going on here with the M2K. And that is the technology, which, to be fair, M2K now is about 25%, or let me say that differently. The Russell 2000, the index on which the M2K micro futures contract tracks, that index is about 24% technology. And that weighting has changed as they rebalance that index. We're starting to get that little bit of a pullback here, potentially into a bull flag. So we're going to look for that to set up another bull flag type of scenario here in the coming couple of candles. But I wanted to pop over to the other grid, and I just wanted to talk through. You can kind of see what it's been doing overall longer term. This is a 1-year daily chart. So I want to go through the characteristics of this particular futures contract. So our tick size is 0.1. So that means that this is our significant digit right here. This last digit to the right of the decimal point. And so it's 0.1. So that's going to move in 0.1 increments, right? So it's going to go 1 to 2 or 3 or 4 or vice versa, right? Down in the same way. If this tick size were 0.5, then we would see this move in 0.5 increments. So it would go 0 to 0.5 to 0 and so forth, right? That's the relationship there. Tick value. For every tick that moves, that's 50 cents. And the point value, if this value right here changes, if this goes from $24.93 to $24.92 like it just did, that's a $5 change in the value of the contract. So we take that value times this number right here, times the current price, and that gives us our notional value of the contract. That's if one way to express that, although it's not a perfect expression because we don't control anything. But one futures contract represents a notional value of $12,467.50 at the moment. Some people express that as, well, this one contract controls a notional value of $12,473. It doesn't control anything. It doesn't impart control over the movement at all. It just simply says that's the representation that this particular contract has. Now, if we can pop down here to our drop down and we go to our futures sub-tab here, and we go to /M2K, we can see that our initial margin requirement for entering a position, either long or short, we need to have $943.80 worth of capital in our portfolio to be able to initiate that position. And then once we're in the trade, then that becomes a maintenance margin position. And so that's going to be somewhere 3 to 5 to 10% less than that initial margin, usually. And then as the contract moves, that maintenance margin is going to change. These are not static. These can be changed at any time based on market conditions, based on market forces. So this is something to pay attention to as you get into the trade, is recognizing the impact that that has on your capital. So if we were to compare /M2K to /RTY, which is the E-mini Russell 2000 Index Futures, same movement, it's doing the same thing. We can kind of see that same relationship here. But if we go to the drop down for that futures contract /RTY, so each tick is, instead of being 50 cents, is now $5. And that means that our initial margin in the trade is $9,436.90 versus /M2K, which is essentially a tenth that. And so it is a smaller impact to capital in your account, perhaps giving you capital efficiency benefits. On the other hand, think about it from the standpoint of gains. This is moving. Each tick that moves is $5. So gains and losses, both in that particular case. It can gain $5 for every tick. It can lose $5 on a tick in the other direction. So that becomes one of the reasons why we look possibly sometimes at some of these smaller contracts, the micro contracts, because that futures initial margin is a little bit smaller, a little bit less onerous in terms of putting a position on. Now, some positions, some portfolios can support those larger position sizes, those larger maintenance or initial and maintenance margins. That's fine. But in terms of kind of keeping with the idea of trading small, as we do these demonstrations, I'm primarily going to focus on those micro contracts. All right, let's take a look at the other one that I've got here that is currently working for us. So that one closed out. We actually made a little bit on that particular trade. Let's take a look at what we got on that one. So open this up, and there's our M2K, and we were up about $30. So $30, $30, $30 if we can continue to do that. No guarantees that we will, but that's how you eke away at increasing your profit and building your portfolio. Now, the one that we have on right now is /MCL, crude oil. This is the micro crude oil contract. And you can see that I've currently got a working order set here. I've got a stop order to get out if it goes against us, and I've got a limit order to get out if it goes in the direction that we want that trade to go. So let's go to the chart. And let's go to our grid here. Let's kind of bring that grid back. Let's restore those cells and go /MCL. This is the micro crude oil contract. We'll go through these characteristics here in just a second. But the entry into this trade was kind of breaking out of this range. So I set an entry order to get in on this breakout. And so it broke out, came back down. My stop order is down here at the bottom of this range at 62.80. That's where, if it crosses back through that range, we're going to exit that position, simply because it's very likely that that has now broken one, maybe two, maybe three levels of support to get to that level, and perhaps be a point at which the trade is now moving in the opposite direction. We maybe look at reversing that position. But at the moment, we're still above that breakout level, which was that resistance at 63, and it's just kind of churning along here. But what I also noticed is that down in this lower panel, that MACD, the CCI, both in this particular case, pushing a little bit higher. Now, it was nice when we first got into the trade, when there was that breakout, and we were starting to see that MACD turning into that positive momentum, and then it kind of came back down. But what kind of gave me a little bit of not comfort necessarily, but a little bit of peace here in this particular case is the fact that MACD never really dropped down to a new lower low. So it never dropped below this low, it never dropped below this low. Still seeing that MACD generally moving higher. So still looking for some upward movement, but we're not getting downward movement at this particular point. And then the target to the upside in this particular case is up here. It's right about, that's where we're looking, setting the target 64.83. So that's right about here is our target, 64.83. So if this continues to move to the upside, if it doesn't, then we've got a pretty tight stop on this to take that trade off in this particular case. And again, no guarantees that this is going to continue to move to the upside, but I wanted to talk through that as we were putting this trade together, because I put these on so that you can see them after the fact and kind of see how they worked out. And I also want to look at one other as we start to kind of go around the futures world this morning, taking a look at /MGC, because this is the one that was already on the move. And this is, in fact, one that I was looking at as a possibility, either direction. And so what I've got going on here, this is /MGC, which is the micro gold contract. And so I saw this run to the upside here in the gold contract, and we've seen gold kind of moving higher. But then it kind of created this channel. And in fact, let me kind of zoom over to this right-hand side here for a second. I'm going to take this channel line and I'm going to activate it, and I'm going to draw it out to here. Now, granted, that's discretionarily drawn. And so because that's discretionarily drawn, there's no guarantees that that is, in fact, going to act as a level of support. But notice what's going on here. MACD momentum is starting to move to the downside. We're starting to see some follow through here on this particular candle. We've got a level of support back down here in this range, right around the 37.92 level. So I'm going to draw a line in right there. And there's a couple of different ways that we could look at this. We could look at this to maybe create a bounce and a move down, or we could look at getting into this trade on that downside move. The other side of this coin is, look at what kind of candle it's giving us right now. So this is always kind of that what if this then that type of perspective. If price bounces up off of support, then what are we going to do? Or if price breaks down below that support level, then what are we going to do? So what I'm going to do is I'm going to put a sell stop order right down here off of this low, because I want to be able to take advantage if this does go to the downside. So I can go short this futures contract and take advantage of that downside movement the same way that I would go long and take advantage of that upside movement. Seeing it's retreating again, it's giving me that hammer candle. So we can kind of put in this conditional here and put this order together. If it breaks out above the upside, if we get a break above this diagonal trend line to the upside, then we might do something a little bit different. We might go long the contract and take advantage of that upward movement. Yeah, I agree, Ron. Yeah, they are. I mean, here's the thing. I subscribe, and you may have heard me say this before. I subscribe to the Jimmy Buffett approach to drawing levels of support and resistance, and that is not too particular, not too precise. Referencing his song Cheeseburger in Paradise, right? The best cheeseburger is one that's not too particular, not too precise. The thought is some traders like to calculate levels of support and resistance to like 6 significant digits of precision, and it just doesn't work that way. So yeah, you're right. I mean, ultimately, it is in the eye of the beholder. It is where you draw those lines. I'm going to draw to the lines that make the most sense, and act as if, right, those are levels of support and resistance. And if they don't bear themselves out, then we adjust, right? So if this, then that. If price breaks that support, then enter the trade, else wait. So what I'm going to do in this particular trade is I'm going to look, because I'm still seeing that momentum weakness here, right? Do you think put a trade on gold and go to sleep? I don't know. I mean, I don't know that we would ever just call it a go to sleep type trade. I don't know that there's ever a go to sleep type trade or a set it and forget it. Some people call it futures. They happen overnight. A lot of those moves do happen in that overnight time frame. So I'm going to put on two different trades here. And we could be working at cross purposes, but not likely. So watch what we're going to do. I'm going to put on this trade right here. Or at least put in the order for this particular trade right here, which is a buy stop at 3806. So I'm going to right click and I'm going to do a sell custom with OCO bracket. And so I'm going to say, all right, we're going to sell this at a sell stop of 3806. And I'm going to make it 3806 even, just to give it a little bit more room. And we're going to leave that as a day order. And then I'm going to look at getting out of the trade. I'm going to buy that trade back if it goes to 37.92. So down to the downside, 37.92. So that's buy it back at 37.92 or better. And when you're buying something, or better is cheaper, right? So that's our downside take profit order right here at 37.92. And then I'm going to stop this. If I get into the trade, I'm going to stop this back on this upside. And that upside in this particular case, actually, you know what I'm going to do is I'm going to stop this if it goes to this line at 38.09. So we're going to make this a buy stop at 38.09 to get out of the trade. And I'm going to make that good till canceled. Now, here's the order that I've got. If I click on confirm and send and I read through this and make sure that this is to open. So what I'm doing is I'm doing a sell stop. So stop, wait, sell it if it breaks below 38.06. Then sell it, get into that short position. Buy it back if it goes back down to 37.92. Or buy it back if it goes to 38.09. So if it goes against me. So this is taking advantage of that downside move. Now, you notice what this candle is doing right now. Okay. So I've got one if this then that statement going on. So my next if this then that statement going on is going to be right here. So I'm going to go to the 38.19. And what I'm going to do is I'm going to right click and I'm going to buy custom with OCO bracket in this particular case. And I'm going to buy this if it goes to or above, and I'm going to buy it with a buy stop at 38.19. I'm going to make that a buy stop, which says stop, wait. Now, remember, that's going to generate a market order. That's a buy stop market. So that's going to be worked as an exchange designated limit order within those protection points. But this is taking advantage of the upside move. So I'm creating. Now, I could link these two. I could link these two orders to being, one cancels other and then have those conditional brackets. We could kind of do that chain logic to put these trades on. I'm doing these separately because at the moment I don't think I'm likely to get hit on this downside potential target. But if we do, if that order does come to fruition, great. So if the thing about it is I want to be in this trade one direction or the other when the circumstances require, but I don't want to be in that position of being in both positions, right? Losing on one side or the other. So I'm going to create the circumstances of this trade such that if I go long, my exit out of the long position, if it goes against me, is before my target on that short side if I'm going short. So we're going to put this order together. So that's going to be my buy stop. My target in this particular case is going to be, I'm going to take this diagonal trend line right here, that flagpole portion. I'm going to duplicate it and I'm going to put it up here. I'm going to just kind of come along that line right there and put it up there so I can see it. Okay. And I just did that for convenience sake. So that target's going to be 38.50 to the upside. So I got a little bit more upside potential in this trade that I'm putting together than I do in the downside potential. That's just generally because gold has been pretty bullish. And so I'm going to put in 38.50 as my upside target. So don't sell it until it gets to that 38.50, sell it at a limit. And I'm going to make that good till canceled. And then I'm going to make my exit out of this trade. If it goes against me, I'm going to make that exit. In fact, let's zoom in on this candle a little bit here. I'm going to make my exit right at that trend line, 38.10. 38.10 is where my stop is going to be if it goes against me. So that's going to be a tight stop, 38.10 against that. So again, this is going to be worked because this is a stop market order. That's going to be worked as an exchange designated limit order. We're going to make that good till canceled. I'm going to click on confirm and send. I'm going to put this in my futures group. And so now I've got two possibilities set up. And this is always kind of that, and this is mentally what goes on in my mind as I'm looking at a pattern that's developing like this. If price goes up, where am I going to get in? And then where am I going to get out if it goes in my direction? Or if price goes down, where am I going to get in? And then where am I going to get out if it goes in my direction? So I'm always thinking along those lines, kind of that if this, then that mentality, right? What am I going to do next if something happens? I'm not trying to predict because I don't know. Quite frankly, this is kind of squeezing down into this range. I'm not trying to predict what it's doing because we can never predict. We're never going to be able to accurately. Ready for what the possibility. All right. So let's pop back over here. Yeah, Ron, absolutely. Yeah, sell Rosh Hashanah and buy Yom Kippur is one of those heuristics that we use a lot, right? Whether it's sell in May and go away, all of those are kind of those sayings that we repeat to ourselves. So there's what we've got going on at the moment, and those are our orders ready to go. All right, let's do this. I want to come back over here to the charts really quick. I'm going to shift over to our index grid, not our index grid, our futures grid, and just see what's going on. So here's the Russell 2000. We can see that kind of continued upward movement in the Russell 2000 on the daily chart, in that daily futures chart. Starting to see that /ES, which is the S&P 500. And if we look at it right here, it's just kind of waffling today, just kind of catching that. It's green. It's a green candle, but momentum in terms of the RSI is kind of going sideways. And the NASDAQ, surprisingly, this is kind of the interesting thing, is that the NASDAQ is backing off a little bit, given the fact that we have some pretty big news in some of the Mag 7 stocks and some of the Halo chip stocks, starting to see a little bit of pullback. So maybe a little bit of profit taking here in this particular case. So my thought was this, and we've got a couple of minutes to do this. I want to come back to my monitor tab, and I want to close down this working order section. I want to close down that filled order section. And I've got this portfolio here of stocks. And what I notice is I unbeta weight this, that I've got kind of a cross section, if you will. I've got healthcare, I've got some utilities, consumer staples, industrials, communication services, a little bit more healthcare, industrials, staples, consumer discretionary. I don't have a lot of technology here. I have really two technology stocks, NVIDIA and Disney, which is technology associated, right? Because it is in the communication services. So this isn't really a very sensitive stock portfolio to, say, for instance, the NASDAQ. But I do have a fair number of small cap stocks in here. And as such, if I were to look at the sensitivity of this portfolio, say, for instance, to /M2K, which is what we were doing before, we can see that the delta sensitivity of this portfolio is pretty substantial. 58 deltas. So if the M2K goes up $1 or up a point, then this is what we're gaining or losing. Down a point, this is what we're losing in our portfolio. Theoretically, that's a theoretical relationship. It is not. It's dynamic, so it's not one-to-one necessarily. So keep that in mind. This is a dynamic relationship, and it always changes because each one of these stocks have their own performance that we have to pay attention to. But if I wanted to hedge off a little bit of that risk, or more importantly, I think in this particular case, not necessarily more importantly, but perhaps not as frequently considered, would be the idea that I can add to that sensitivity if I wanted to in this particular portfolio, and I can increase that sensitivity by adding a futures contract. Just like I can decrease the sensitivity by adding a futures contract in there for hedging, right? For hedging. So we could augment the performance of this stock portfolio that is performing nicely based on the movement of the S&P or the small caps by adding a long position in the /M2K. Now we go back up here to our working order, our filled orders, and we are long still. Nope, we got out of that M2K trade. But what we could do is we could go now to the trade tab /M2K, and we could go long another contract and take advantage of that. I'm going to actually go back to my futures grid, not my flag bounce grid, my futures grid. There we go. And we'll go /M2K. And notice that it's still kind of holding this level right here. Now, in this particular case, I'm not trying to capture a particular move. I'm trying to capture direction by adding to or taking away from the directional sensitivity of my stock portfolio. So what I'm going to do in this particular case is I'm just going to simply add a long position in this particular instrument. I'm just going to go long the /M2K, and I'm going to put it in my stocks group. I'm not going to put a stop order on it. I'm not going to put a target order on it because I'm using this as a hedging or an augmentation tool. If I were hedging, I would go short. If I were adding to the sensitivity or augmenting this, I'm going long in this particular case. So I'm clicking on send, and we're going to fire that order off, and we'll see if that order fills. And it filled. Now we are long that futures contract. Now, if we go back to our monitor tab, we can see that we added about 10 deltas to this portfolio because we now have this long /M2K position here. That's adding to the sensitivity of this portfolio. And that's giving us that opportunity to kind of increase that potential. Now, what we could do as this starts to move and maybe the MTK or the Russell 2000 starts to roll over a little bit, starts to slow down, peel back that futures contract, close that futures contract, and take that off if it starts to move against us. But I just wanted to present that as another method in which we could use this beta weighting tool, which we've talked about before. But we don't always have to hedge against adverse movement. We can augment if there is positive movement, as we were seeing here in the /M2K, and it's now starting to move up, or in the Russell 2000, which is the index. And again, looking at the sensitivity of our portfolio in that sense. All right, so if you want to learn a little bit more about this, I'm going to show you some resources right here. Pop over here to the Trader Talks webcast page and just type in hedging. And if you pop in there and you talk about hedging, you type in hedging. I talk about hedging with index options. I talk about hedging with futures. Connie talks about it. Brent talks about it. James talks about it. So we talk a lot about that idea of how do you beta weight using portfolio risk. These are some good additional information for understanding that hedging process. So join us over here. When you do that, click on subscribe. You can click on it right now, too, if you haven't already. Click on subscribe. It's at no cost to you. It's a helpful tool to be able to kind of keep you in the loop in terms of the community. And, as you do that, make sure that you set alerts for new content. Also, give us a follow, Mike and myself on X. At Ben Watson CS is my handle. At Mike Fairborn CS is Mike Fairborn's handle. And then, I mentioned at the very beginning of the discussion, I mentioned the fact that we were in Dallas just this last weekend. If you come over here to schwab.com/coaching and you click on in-person events, we're going to be in Chicago on the 4th of October doing another market drive event. Then we're going to be in Orlando the 10th and 11th of October doing a 2-day technical analysis and option strategies workshop. Then in November, we're going to be in Anaheim doing a market drive event. Then we're going to be in Houston. And then we are going to end the year in Miami doing our advanced option strategies workshop, which also has a segment on introduction to futures. So join us for that. And now I just happened to notice this over the horizon. We're going to be back in Dallas in January. We're going to be in Seattle in January, end of January. We're going to be in Sacramento, which is a new location for us, February 6th and 7th. Then we're going to be down in San Diego. Then we're going to be in Atlanta, and then we're going to be back in Denver. So you've got a bunch of opportunities to join us. Now, Joe says no Myrtle Beach. I will tell you this: I personally am going to be at the Sarasota, Florida branch on the 8th of October ahead of the Orlando event. So if you want to join us over there. In Miami, we're in Aventura. We're going to be at the JW Marriott Turnberry, which is a beautiful property. So my thanks to Michael Fairborn for helping out. My thanks to our great production staff for helping out with this, and to all of you for joining us. And we appreciate you being here. And we've got a lot of great stuff coming up. I'm going to be teaching Connie's trading or selecting an option strategy webcast later today. So join me there. And Mike has got a bunch of stuff going on too as well. So we will see you guys later today. Take care, everybody. Have a great day. Bye-bye.